Hey traders, welcome to Charts and Coffee. Happy Wednesday, everybody. Hope everyone's doing well on this CPI release morning. Let's go take a look at the hot zones before we jump too far into the charts, because that's really where a lot of the narrative is as of right now. Taking a look at the Forex Factory calendar here. Scroll on down to Wednesday, and you'll see that we have really the second most important CPI, our second most important inflation indicator in the CPI. Now, I say second, not because it's not good data and not because it's not important, but it's not the one that the Federal Reserve considers to be the one that they use. It's not the one that they're incorporating into their models. Therefore, as important as it may be, it's not the one that they're really focused on. So it's really not the one that we should consider to be, say, a needle mover in their process. But nonetheless, it is an important release. By the way, before I get too far into the CPI and even into the Fed Fund futures, the way they look after the CPI, please direct your attention to 9 a.m. right now. Bank of England Governor Bailey is speaking. Not probably that big a deal, although the British pound has been a very strong currency from a relative performance standpoint the last week or two. The one that I want everyone to be aware of, and it's often one that catches traders off guard, is the Bank of Canada, the BOC monetary policy rate statement, overnight rate. All of that is hitting at 10 a.m. 1 hour later, we've got the Bank of Canada presser. The 10 a.m. hot zone has been one that moves the U.S. markets, definitely moves treasuries. It's going to be just another significant central bank, one that we have geographic proximity to, obviously, a trading partner. But that Bank of Canada 10 a.m. hot zone has been one that has been moving indices and treasuries. So just keep an eye on that one, not necessarily one that a lot of non-Forex traders would have on their radar. So keep an eye on that. Okay, and then as if that isn't enough, we got through CPI, we get through Bank of Canada, we get through the 10-year bond auction at 1:01 p.m. Eastern, and here comes our FOMC meeting minutes. We get a sneak peek at the conversations happening behind the scenes, so to speak, at least conceptually, around the previous meeting where they hiked. And there was a lot of discussion that it was a very, very difficult meeting to come to consensus on in terms of whether to hike or to hold. And that will probably get a little bit more insight into why do I care about this particular meeting. Frankly, I usually don't pay that much attention to meeting minutes. It's a hot zone. It's got a little bit of volatility, but then we just move on. This one could be different, because if the question is, how close are we to an eventual hold? May is most definitely still in that. Well, actually, I shouldn't say that. Let's go take a look at May. But one of the reasons this is so interesting, this particular meeting minutes, is because we've had this expectation that the Fed could pivot. I say we, because I'm using the Fed Fund futures as a consensus. And if I take a look at May, this is still far and away a hike. If you're wondering, Rog, how on earth do we know that? By looking at this chart, this graph, if you will. And the reason we know that is because we can see in the center of this graph here, I'm going to circle it for y'all. This is the current rate. Okay, cool. This would therefore mean, because of the 500 to 525 basis points, this would be a quarter point hike. This would then be the hold. So this is a hold. This is the hike. And this is 71.25% discounted after 34 minutes after that CPI release. So absolutely still seeing a hike. Yes, the Federal Reserve is still going to be hiking, but then the question is, when do we hold? And it's still and increasingly becoming a hold in June. It's the June meeting here. Okay. We move out to July, and July gets interesting, more so than ever, gang, we can see that the quarter point cut is starting to get factored in. So I know a lot of folks are saying, but the Federal Reserve said the base case is not for rate cuts. I get it. But remember, this is a communication device. All right. This is as much reflecting what we think the Fed may do, and in many ways, what they should do, right? Bonds like to play a game of chicken with the Federal Reserve, and Fed fund futures seem to be doing the same thing. They're communicating to the Federal Reserve, if you don't cut, you better start giving us that dovish monetary policy words, right? You better give us a pivot in words, if not an actual rate cut. Come September, if this looks like it does through summer, and that seems eons away, but if it remains like this, gang, there is a battle ensuing. And this is very much the market, right? Us, traders, investors, people who are putting skin in the game by trading a contract called the Fed Fund Futures. This is not opinion. These are folks actually placing a trade and reflecting what they're expecting. Come September, there better darn well be some cuts, say the Fed Fund Futures. Okay, that's where we sit, gang. Always measuring data from a rate of change basis. And you'll notice that even in the newsletter or This Week in the Market, it's one thing to have a narrative, but we've got to back it up with data. And you'll see the This Week in the Market reboot is full of data, full of charts, full of graphs, because on one hand, we could talk about what the Fed could do and what they're looking at, or we could have a rate of change, meaning what's the trend in data, and then start to extrapolate from that what the heck we think is going to happen. All right, so let's get into it, gang. Let's jump into our questions, and we'll jump into the charts. And we're going to stick with some trading view charts again. We did this yesterday. I figure we'll use them again today. A lot of folks either don't want to or cannot use TOS, and this trading view platform is an excellent alternative. I think it's really a fantastic supplement to having another set of charts. It's broker agnostic. I'm a big fan. I've been using it for about a decade, and I'm a big fan. All right, so let's get into it. Good morning, good morning, good morning. All right, so, well, actually, since we're on this 5-minute chart, let's take a quick peek at what we've got here. Take a look. What we have is our 830 hot zone. There's our move, and we're taking back about 50% of the move here, as you can see. But the initial reaction was up. One thing to note, gang, do you notice I haven't even once mentioned what the data actually was? And that's because I don't really care. I don't really care what that CPI number was, not initially, anyways. What I'm much more interested in is where the reaction took place in the Fed Fund Futures on the price chart. And if you take a look, CPI came in at 0.1. And if you notice, it's less than expected. Core, by the way, came in line, but core is such a quirky number. Core to me is about the dumbest thing we can look at. If we're looking at inflation, core says, let's look at inflation minus food and energy, because who needs that? Who needs sustenance and power? Nobody. But their rationale, and sometimes think about how ludicrous some of these data points really are, but they move the market, right? This is the measuring stick we have, even though it's about the dumbest thing I've ever seen. So what happens is, if inflation is obviously important to the Federal Reserve, the logic to removing food and energy is because it distorts, right? Because it distorts the trend, because it can be so volatile. If we're measuring inflation in the world that we live in, to me, core is just about the dumbest thing we can actually calculate. I know a lot of you think, Rog, the whole thing's pretty dumb, but this is what we've got, right? CPI, the non-core, is, I think, far more important, and that came in a little bit cooler. Cooler means what? In this case, the lower number, I won't call it a miss, right? It's better to have lower inflation in the environment we're in right now. Why do the equity markets go up? Because lower inflation communicates to us, and the Federal Reserve can point to it and say, see, it's working, right? It's a delayed reaction, which is true, but it's working, right? And so therefore, why would they have to be more hawkish than maybe one more hike in May, right? So that's the thinking, and that's why equities initially moved higher. Okay, so over to our charts, and our first question. Robert asks, now that we've had CPI this morning, will that data affect the 10-year auction this afternoon? Look, the data is already going to start moving the 10-year, Robert. And remember, futures are always, I love futures. Here's why. The delivery month, for example, if I pull up the 10-year futures contract, most of you that are futures traders will know it's the ZNM, as in June contract. So let's take it to something much more tangible. If we were buying corn and you bought July corn, what does that mean? That means come July, if I own that contract, I'm then saying I want to buy 5,000 bushels of corn. If I'm a farmer, I owe whomever has that contract 5,000 bushels of corn. All right, now let's replace corn with the 10-year note. Whatever the value is expected to be come the contract month, that's what we think it's going to be. So futures are always thinking in the future. What's the expected value of this thing that needs to be delivered upon come whatever that contract month is, that delivery date? It's easy to kind of make the delivery dates not feel as real when it's a June contract of the S&P or the June contract of Euro. But when we think about actual good old-fashioned grocery store commodities like corn, delivery makes a lot of sense, right? Okay, I'm a farmer, I'm going to deliver it. I'm a buyer, I'm going to take delivery of it. So anyway, what I want to look at now is 10-year notes are going to react to CPI, but they're also thinking about, what is it that we're going to expect? This is the June contract come June. And another thing you can look at is, how does the June contract look? How does the September contract look? How does the December contract look? Those are the contract dates. And why do we want to look at those? Well, if we're expecting the Federal Reserve to cut rates, or at least pivot in messaging, the yield for December's bond, 10-year, 2-year long bond, should be lower than September, and September should be lower than the current month, because that's going to then discount the fact that traders who are trading that contract are expecting lower rates, because the Federal Reserve is going to shift to a more dovish monetary policy. So all of that's baked in too. Remember, right now, just about 45 minutes after that CPI, we've got a lot of the CPI reaction built in. But remember, these notes traders are not thinking, well, it's just about CPI. No, they've been thinking about this auction since at least last week, right? So will it magnify the effects later? Again, always remember, the markets are looking ahead. Stocks are looking ahead. Data is looking back. Isn't that funny? Data looks behind what happened the prior month, what happened the prior quarter, what happened the prior week. Equities are saying, what do we think is going to happen? What's the future value of Apple? What's the future value of crude oil? What's the future value of notes? So do I think it's going to make that much of a difference? My opinion is no, but it's just my opinion. But I don't trade my opinion. I trade what I see and not what I think. What I see will be this, Robert. Put on your chart whatever it is you make decisions based upon. In the Sector Secrets room, or anyone who took the DPMR masterclass, one of the things that we make decisions based upon is our daily price movement range, which is right in here. Futures are not a 9:30 to 4 o'clock world. They're far bigger. They're far more complete. The DPMR has already spoken. 10-year note has already said we're bouncing off of support. We've already moved up into resistance. And I think it's going to be important to see whether or not we can continue to move higher or not. The 10-year on the daily, the daily time frame has been neutral and has been holding above the 200 propulsion pretty darn well. And we're clearly, as you can see here, here's 2023. We are also trading above the point of control. The most volume, the most contracts that have been traded at a specific price since the beginning of the year. I think a lot of that expectation for this afternoon is already, as they say, baked into the cake, Robert. Okay, and that's the process. I hope that makes sense. All right, Tesla. Hey there, Robert. What do I want to do with Tesla? Nothing yet. Nothing yet. And so it's not that I don't have a potential plan in mind. I'd rather be long Tesla than not, but I'm not at a point on the chart, as you can see on the daily here. I'm not at a point on the chart where I can do anything by way of either being at a volume level or a volatility level. Now, if I do want something actionable on Tesla and I'm not seeing it on the daily, I can start looking on the intraday. I'll let the bell ring and then I'll start asking myself, okay, what kind of structure do we have on Tesla today? Well, looks like it's green. That means I'm going to be looking long only. If I'm looking long only, thank you, HPMRs, right in here. I want to be a buyer if we dip down into this level, this HPMR zone right in here. So these are time and volatility based zones, right? Zones that most folks, frankly, outside of Simpler, don't see. I know that because, well, I created them. And so we have an interesting advantage, but to looking at a time and historical volatility based zone. What that means is I've gone back and I've looked at 6 months of data, not just 6 months of data in Tesla, but 6 months of data broken down every hour to look at what we typically do each hour of the day. And you'll notice these update every single hour because we all know, even if it's anecdotally, every hour of the day does not behave the same way. We know 9 to 10 and 10 to 11 are very different than 11 to 12 or 12 to 1 Eastern. We know 8 to 9 a.m. is very different than 8 to 9 p.m. So why look at all hours of the day with equal expectation for volatility? It's actually inaccurate. So what we do is we factor that in to these zones. All right. So that's what I would do with Tesla. Short term, Robert, maybe a day trade until we enter a zone that's actionable on an hourly or a daily time frame. All right. Can we take a look? Can we talk on building positions intraday, adding to a winning trade? I don't add to anything, Avi. I don't build anything in that. If I have a zone that I want to enter, let's just stick with Tesla, Avi. Yeah, so it's probably more semantics than it is tactics in terms of what I'm going to tell you. It's really more semantics. I don't like the word add. And I know, Rog, really? You don't like the word add? I don't. Unless it's, please add more nuts to my sundae. Right. Other than that, no. Add really should be replaced with the word setup. Each quote unquote ad really should be its own setup, right? It's always about a setup, never just randomly adding. And that's why I don't like the word, because setup has a completely different connotation as opposed to add. All right, having said that, if this is my zone, this is my aggressive, my moderate, my conservative. Why? Because I'm an old school trader, and old school scaling in and scaling out was pretty much the norm. It wasn't this binary A to B that we see so often now. Sadly, it's really more along the lines of what is a predetermined zone that I could build a position in, to use the word you're using, building, and then where can I start to scale out? And so that's the way that I look at it. And so if something's winning, is that a reason to add? Never for me. Only if, as the price action progresses, maybe we went from a sideways market and a breakout, or a sideways market and an oversold buy, to now it's trending and now I can buy the dips. So each quote unquote ad is actually a setup in and of itself. And that's the way that I do it. So again, it's not a tactical difference, because you might say, well, Ron, that's adding. I really don't believe so, because adding presupposes that the second or third or fourth entry has something to do with the first entry. For me, it doesn't. Each one has to legitimately stand alone in its validity, in its confirmation, and in its stop loss, right? It's not just one big position. And that's I hope that makes sense, Avi. That's why I do not like the word add. So, but it is looking for more opportunity, which I think is exactly what you're looking at doing, Avi, right? Okay. So Jim asks, when I look at ZB today, sure. All right. Is that based on the June contract? Oh, okay. So yeah. So the question is, what are these contracts? Sure. So take a look. If I pull up ZB, and I'm on TradingView right now. So if I just type in ZB, just a symbol, notice all the different choices I have. The reason I do ZB, the number one exclamation point, is that's the coding on TradingView that allows us to look at a continuous contract, one that rolls from March to June to September to December seamlessly, so I don't have to keep pulling up the ZBH, ZBM, ZBU, ZBZ contract as we go through each month. So just more flowing. Some people like them, some people don't. I think it makes life a whole lot easier. All right, so then I want to look at the different months. See this here, Jim? June. If you're ever wondering what contract are we trading, what you can do is pull up the continuous contract and look at the price, 133, right? And then pull up ZBM. That would be the June contract, ZBM 23, right? I think that's, let's see, how do they do? Oh, they do 2023. Okay, so click on that and see how it's trading in the same spot. So this is how I know this is the June M contract. When I look at the continuous contract, it looks just like the June contract. If I were to pull up ZBU, right? So now I would say, look at September. This is just Futures 101, gang. And I love the questions, Jim. Love it. A lot of people are really not sure how these futures things work. And therefore, it keeps them away from the futures markets. When in reality, being a futures trader, I'll even say being a currency trader, treasury trader, energy trader, right? Which is all the different parts of the futures market, right? Grains, softs, energies, treasuries, metals, etc. It's going to make you a better trader in equities, period, right? Anyway, look at you. Completely different conversations, trading at 132.30. It's obviously very sparsely traded. So now you know, okay, if I'm looking at a continuous contract, compare it to the actual month. And just like that, gang, I've run way over. So thank you as always for being a part of Charts and Coffee. If you like the analysis, come take a look at what we're doing back at the Simpler Trading YouTube channel. You can check out my free videos there. Get a good feel for whether or not this is the style with which you might want to trade and become a more proficient trader, if that's what you're looking for. If you're looking for a little bit more macro discussion, like we started the show off with, check out This Week in the Market. We've rebooted it. And This Week in the Market is all about the big picture, right? It's about and not to make it daunting. It's a lot of graphs. It's a lot of data. It's about a 15-page report that I put out once a week, just to kind of put you in sort of, I believe, a data-driven outlook about where equities are going. All right. Okay, gang. And not just equities, energies, currencies, treasuries, etc. So I'll see you all tomorrow, same time, same station. Be good to each other.